Welcome to the Deep Dive. Today we're really diving headfirst into something quite strange, a real financial head-scratcher.
Yeah, it's one of those situations that, on the surface, looks like fantastic news for a company.
Exactly. But the market reaction, completely the opposite. It's fascinating. We're talking about quantum computing, Inc. The ticker is QUBT.
Right.
And on October 6th, 2025, they announced this, well, really impressive private placement. Overdescribed even.
Mm-hmm. Which usually signals strong demand, strong faith from investors.
Totally. They're selling 37.2 million shares, the goal, raising a whopping $750 million.
I mean, that sounds like hitting the jackpot, right?
Yeah.
Especially for a tech company that needs capital, cash runway secured.
You'd think. That much cash, it seems like phenomenal success. A company moving from potential to, well, having actual massive cash reserves.
It really should be a moment for, maybe not celebration, but definitely confidence, confirming institutional belief in their long game.
Cash is king, after all. And $750 million. Is that a lot of runway?
For a development stage company,
Yeah.
absolutely. Years, potentially.
Except the market just screamed no. The stock dropped almost 15% in pre-market trading right after the announcement.
Yeah, a really sharp immediate sell-off. It's like they were punished for succeeding in raising money.
So our mission today is to figure out why. Why did this happen?
We need to look past those headlines, understand the deeper financial mechanics at play, things like dilution, adverse selection. These concepts really drive investor reactions to capital raises.
And this is, I think, really vital knowledge for you, the listener, especially if you're watching these high-growth, maybe highly speculative sectors.
Definitely, because the core question is, why does getting the money you need to survive and grow often send such a, well, profoundly negative signal about your current stock price? It seems backwards.
Okay, so let's start with the company itself, QUBT. Context is everything here, right?
Absolutely. QUBT is what we call a pure-play quantum computing company.
Meaning quantum is all they do.
Exactly. They specialize in integrated photonics, quantum optics. It's very cutting edge, very deep tech.
So the definition of speculative, future-facing, high risk, high reward potential.
And you see that speculation reflected immediately when you look at the financials, or maybe the lack thereof.
What do you mean?
Well, look at the revenue versus the market hype. Their trailing 12 months revenue, TTM, was tiny. About $263,000 recently.
Wait, hold on. $263,000 in revenue for the whole year.
Roughly, yeah. That's the scale we're talking about.
And yet the market cap was, well, it must have been enormous given the stock run-up.
Exponentially higher. This isn't a valuation based on, current earnings or sales.
It's based on hope, like a lottery ticket on future quantum breakthroughs.
Precisely. And you see the other side of that coin, too. In 2024, they posted big losses, deeply negative profitability. We're talking, nearly $68.5 million in the red?
So burning cash, a development stage business, as you said.
Yes. And the whole industry is like that. It's so volatile, even their competitors admit financial disaster is a known risk. It's baked into the sector.
But the hype.
Yeah.
Wow. The stock performance leading up to this was just unbelievable.
Staggering is the word, a gain of 3,410% over the last year before this announcement.
3,000%.
Yeah. And that meteoric rise, that's really the crucial starting point for understanding the market's reaction to the share sale. Because when you have a run-up like that, completely detached from current fundamentals, many analysts already see the stock as, massively overvalued,
Right.
writing pure excitement.
Okay. And then there's the volatility itself, the beta.
Right. The stock has a high beta, 3.86.
And for our listeners, what does that 3.86 really mean in simple terms? It sounds high.
It is high, very high. It basically means the stock is almost 4 times as volatile as the overall market.
So if the S&P 500 moves 1%,
QUBT, statistically, is expected to swing almost 4%, maybe up, maybe down. It's just amplified movement.
like strapping a rocket engine to market swings, as you said.
Exactly. So any news, good or bad, is likely to provoke an extreme reaction. The stage was set for a big move.
And the scale of this funding effort was also pretty extreme, wasn't it? This wasn't their first big raise recently.
Not at all. This $750 million raise came hot on the heels of another one. Just 11 days prior, they closed a $500 million private placement, also oversubscribed.
Wow, so that's $1.25 billion raised in less than 2 weeks.
And according to the CEO, the total raise since November 2024 is now $1.64 billion.
That's a huge amount of cash.
It gives them an estimated or pro forma cash position of around $1.55 billion. Management says that fully funds their business plan through 2028.
Okay, so they've built this massive war chest. They're incredibly liquid compared to peers. Should be secure for years.
That's the narrative they're putting out.
And yet,
Yeah.
the market delivers a 15% punch in the gut. So we have this super volatile stock. It's run up thousands of percent. It's arguably way overvalued based on today's metrics, but it's now backed by almost $2 billion in fresh cash commitments. Why does Wall Street look at that picture and just slam the sell button?
Okay, so let's get into the theory. The first piece is the most direct, the most mechanical reason. It's dilution.
Right. More shares flooding the market.
Exactly. When a company issues 37.2 million brand new shares, like in this private placement, it simply increases the total number of shares out there.
And for anyone holding stock before the announcement?
Their piece of the pie gets smaller. Instantly. Your percentage ownership goes down. Your control, theoretically, is diluted.
And given these two massive raises back to back, we're talking about significant rapid dilution here.
Very significant. And beyond just ownership, dilution hits a key metric investors watch closely. Earnings per share or EPS.
How so?
Well, even if the company uses this cash brilliantly and profits eventually surge, in the near term, any earnings they do make have to be divided by a much larger number of shares.
So the earnings per share figure goes down mathematically.
Guaranteed.
Yeah.
And a declining EPS figure is almost always seen as a negative signal by the market, even if everyone knows why it's happening temporarily because of the share issue.
Okay, so dilution explains some downward pressure. But you mentioned historical data suggests typical dilution hits are, what, maybe 2–3%?
That's generally the range, yes.
So to get a 15% drop like QUBT saw,
Yeah.
there has to be more going on, something deeper, maybe more psychological.
Absolutely. This is where we get into information asymmetry and the concept of adverse selection. It goes way beyond the simple math of share counts.
Adverse selection, that sounds ominous.
It relates back to some really foundational work in corporate finance. There's a famous model by Myers and Majluf from the 80s.
Okay, what's the core idea?
The core idea is simple but powerful. Managers inside the company know more about the firm's true health and future prospects than outside investors do. There's an information gap.
Right. Insiders always know more.
And this gap, this asymmetry, creates the potential for adverse selection when companies decide how to raise money.
So what's the signal management sends when they choose to issue new equity? Like QUBT did with this private placement. Essentially selling primary shares to put cash in the company coffers. Why not use debt or cash they already have?
Well, according to the theory, when managers choose to sell new shares, investors read that as a signal.
They signal that.
A signal that management believes the company's stock is currently overvalued.
Ah, okay. Why would they think that?
Think about it from the manager's point of view. If they genuinely believed their stock was undervalued, dirt cheap compared to its future potential, would they want to sell it now?
Probably not. They'd want to wait or use debt maybe so they don't give away future gains cheaply.
Exactly. So by choosing to sell equity now, especially after a massive run-up in price like QUBT had, they appear to be timing the market, taking advantage of what they might privately believe is a temporarily high price.
So the market interprets it as opportunistic. Management saying, hey, our stock is flying high, maybe too high, let's cash in and issue shares while the getting's good.
That is the classic adverse selection interpretation. It suggests management lacks confidence that the current price level is sustainable based on fundamentals.
And you said history backs this up. Stock prices usually drop when companies announce equity offerings.
Right, yes. The data generally shows that. Historically, the average stock price reaction on the announcement day is negative, usually in that -2% to -3% range we mentioned.
But hang on, isn't that theory like 40 years old? Does the 1984 model really capture the dynamics of a hyper-speculative quantum tech stock in 2025? Seems like a different world.
That's a fair question. The world has changed, technology has changed, but have fundamental human incentives changed?
Probably not. Managers likely still act in what they perceive as their best interest, given the information they have.
Precisely. And subsequent research has largely confirmed the pattern. Firms issuing primary shares often do seem to time their offerings around periods of, say, temporarily high earnings or peak market sentiment that might have inflated their stock prices.
And there's evidence this is followed by weaker performance.
Yes, there's documented evidence of a subsequent deterioration or at least a leveling off in operating performance after these primary share offerings. The market knows this history.
So for a stock like QUBT, already seen as potentially frothy,
The fear that this historical pattern might repeat itself gets amplified. The market becomes extra sensitive to that adverse selection signal.
okay, let's bring this all together now and apply it directly to QUBT's situation on October 6th.
Yeah.
That 15% drop, it's way bigger than the historical -2% to -3% average.
It's about 5 times larger, yeah. Which tells us the market's reaction was extreme. We need to see what factors made QUBT's case so severe.
It sounds like they basically checked all the negative boxes at once.
In a way, yes. They seem to have maximized several negative signals simultaneously.
Okay, like what?
First, you had the maximum possible valuation run-up, that 3,420% gain in the past year, when a stock is already floating that high above its current financials.
The signal that management thinks it's overvalued by selling shares becomes much, much stronger. More credible, maybe?
Exactly. The adverse selection signal hits with maximum force. Second, they hit the market with maximum dilution risk, or at least the perception of it.
Right, not just one raise, but 2 huge ones, back-to-back, within just 11 days.
That speed and volume looked aggressive.
Hmm.
It suggested a real urgency to capitalize on that high stock price now.
Okay, so extreme valuation context, extreme dilution perception.
Yeah.
What else?
Well, this rapid-fire fundraising overwhelmed any positive spin the company tried to put on it, and they did try.
They did announce what the money was for, right?
Oh, yes. They laid out a clear strategic plan, fully fund commercialization, pursue strategic acquisitions, establish volume production capabilities, expand sales, and engineering personnel.
I mean, that sounds good. That sounds like exactly what a growth company should be doing with new capital. Aggressive investment in the future.
Logically, yes. And sometimes, for certain early-stage growth companies with very optimistic investors, raising equity for expansion can be seen positively.
Is that the Tesla exception you mentioned earlier?
That's a good example. Tesla has raised cash many times. Often the stock dips initially on the dilution news, but then the market focuses on the growth potential, building new factories, launching new models, and the stock recovers or even rises. The long-term vision outweighs the short-term dilution.
So why didn't that happen for QUBT? Why didn't the market buy into their growth story?
Because QUBT faced a crucial third negative signal, one that arguably crushed any hope of that positive Tesla interpretation.
Which was?
The insider signal. What were the managers and other insiders doing with their own shares?
This always comes up. The trust factor. Are they putting their money where their mouth is?
Exactly. And in QUBT's case, the data wasn't reassuring. Over the 6 months leading up to this, insiders reportedly executed 16 sales of their own stock and 0 purchases.
16 sales, 0 buys, while the company is raising $1.64 billion from outside investors.
Precisely. So when the management team is selling their personal holdings into the stock's strength, while simultaneously asking the market for huge amounts of cash by issuing new shares,
The market reads that loud and clear. It looks like they're cashing out at what they perceive to be a peak, confirming the adverse selection fear.
it powerfully reinforces the idea that management might not believe the current valuation is justified long-term. If they thought the stock was a bargain and poised for massive growth thanks to this new cash.
They'd be buying alongside the new investors, not selling.
That's the typical reasoning, yes.
Okay, so let's recap the market's likely interpretation here. QUBT secures its future, funding through 2028, massive cash pile, more cash than debt.
A seemingly strong position on paper.
But the market's immediate, brutal 15% reaction tells us what it really focused on.
It focused on the convergence of negative signals.
Extreme dilution from back-to-back raises. Opportunistic timing after a massive, potentially unsustainable stock run-up.
Suggesting management thinks the stock is overvalued.
And then the insiders selling just hammered that message home, selling their own shares while raising external capital.
Right, so the negative perception management capitalizing on a peak, diluting existing shareholders, significantly, completely overwhelmed any potential excitement about the strategic growth plans.
The market basically decided that the cost of this equity financing, in terms of dilution and the negative signal about valuation, was way higher than the immediate benefit of the cash itself.
That 15% drop can be seen as a price QUBT had to pay for choosing to raise equity capital at that specific moment under those specific, highly scrutinized circumstances. The market extracted its pound of flesh for the perceived opportunism.
So the QUBT stock drop on October 6th, it really is a perfect storm, isn't it? A textbook case almost amplified of these core financial tensions.
I think that's right. It vividly illustrates the market's deep-seated skepticism about these kinds of equity offerings, seasoned primary offerings, especially when they happen after huge stock run-ups and involve companies built more on hype than on current results.
It forces you, the listener, to remember the raw power of dilution, but also that subtle yet powerful information signal embedded in how a company chooses to fund itself. The signal of potential overvaluation is always lurking.
Always.
Okay, so here's the final thought we want to leave you with. Something to chew on as you watch QUBT or any company like it going forward.
We talked about that historical pattern. Firms that do these kinds of primary share offerings often see their operating performance lag afterwards. Their long-run stock returns tend to underperform benchmarks.
Right, the post-issue decline is a documented phenomenon.
So now QBT has this incredible $1.64 billion war chest. They say they're funded through 2028. The critical question for you, the investor, isn't just why they raise the cash anymore. We've kind of unpacked that.
The question now is, what happens next?
Exactly. Can management actually defy that negative historical pattern? Can they take this massive pile of cash, raised under what the market clearly saw as opportunistic circumstances, and translate it into real, sustainable operating results, actual products, actual revenue, actual profits down the line?
Can they turn that hype, that lottery ticket, into a genuine, thriving business? Or will the market's initial skepticism prove correct?
That's the multi-billion-dollar question. And watching how they deploy that capital and whether they can break the historical trend, well, that is the real deep dive from here on out.